All right, welcome everybody to Finance 444. This is week 2. Frida, special thanks to you for joining into the live session. Hopefully we'll make it entertaining and exciting and informational. But more importantly, hopefully you come away from tonight or from reviewing this session with what you feel like is good preparation for this week's material. So far I've graded everything but the assignment for last week. I'll have the assignment graded by probably tomorrow morning. So that you'll know exactly how you're doing at this point in the course. There are a handful of you who still need to turn things in, especially the assignment. If you have any questions on that, let me know. The material is straight out of the chapters, but you can also just use some online research, maybe Investopedia, other sites to look up fundamental analysis and the components of fundamental analysis, which hopefully some of you found that an interesting exercise last week as far as the assignment is concerned. So hopefully I'll see a few more of those assignments. Remember, I do accept late work. I don't accept it for full credit. You will get discounted for turning it in late. However, you'll get most of the credit, and most of the credit on assignments that are worth 120 points each, or more than one full letter grade each, are very important to your overall score. So I just strongly encourage you to stay caught up on those assignments. Get them in so you can get those points. So everything else looked good. I thought it was a great week on the discussion board. I was out a few days with a wedding, so I wasn't able to participate as much or as often as I'd like to. But we'll be able to participate a little bit more this week and interact a little bit more with this week's board. So thank you for those of you who participate early and often. That helps the culture of the board to be positive and for people to feel like they're getting something positive and good from the board by interacting with each other. So just appreciate all of you for participating, especially those of you who, as I mentioned, are able to participate early and often. I realize some of you, just different circumstances preclude you from doing that, and that's just fine. I just really appreciate people who get in there if they can and start the board off and get it going. So thank you on that. As far as grading, as I mentioned before, just a quick reminder, if there is something wrong with your assignment or assessment or discussion board, you'll know, right? And as far as assignments and discussion boards, specifically, you're able to edit and update and resubmit in order to achieve additional credits. So for a few of you last week, you got off to a great start, got a main post in, and then the weekend got away from you and you weren't able to get some responses in for full credit on the discussion board. If that's the case for any of you who are reviewing this, I'd just encourage you, as I did in your grades and with the response that I gave you, to go ahead and go back in, submit some responses so that I can then grade them and get you some additional points. Okay? All right, so as far as last week is concerned, Frida, any questions that you have that I can help answer from last week? As a reminder, I'll have all the grading done. School policy is by Wednesday at noon. I like to grade things together. I usually wait, though, until Monday, and I did today. So everything's been graded, like I say, except the assignments, and we'll have those probably done tonight, but if not tonight, by tomorrow morning. Okay. And then as far as work that's submitted late, no guarantees other than that'll be graded before the end of the mod. Okay, if work gets submitted after the due date. All right. So a very topical conversation. We're bouncing around a little bit in the book, but we're going to be talking about taxes tonight and tax policy, and then we'll be talking about budgets and savings for Chapter 4. So Chapters 3 and 4 are the text for this week's material that's due. And the assessment, just as a heads up, is only 10 questions. It's short like last week. It's not comprehensive. So it's just over these 2 chapters, which is nice. And it and there was a little bit of a bug with the link to the assessment last week. Some of you noticed that, and then I updated the link so that it was working. But if you ever have that happen again, just go into Pages or Quizzes and actually find the assessment another way into the assessment so you can get to it. So I don't want to stop anybody, because of a bug on the site from taking the test when they want to. That's just a tip as a workaround. Still let me know, and I'll still try to fix it if I find something like that. But if for the sake of timing, you want to just get in and take it, if there's ever a link that's a bad link or not working, just go ahead and maybe just poke around on the side a little bit and find another opportunity to get to that same page. So even though that link was broken early on last week from the main page, if you went into the week and then you went into Pages and then went into assessments or quizzes or whatever, then it actually worked from there. That's how I ended up repairing it, is just circling it back from another place on the site. Okay, so just a little heads up, but if you ever get caught on something like that or find something like that about the site, please let me know. I'll get in and fix it as fast as I possibly can and get you up and running again. Okay, so this is a very topical conversation that we'll be having tonight when it comes to taxes and tax policy. A lot of the debate, the first presidential debate that's going on tonight between Clinton and Trump, has to do with jobs, the economy, of course, and also has to do with tax and tax policy. And the difference between tax policies for Donald Trump and for Hillary Clinton are significant, right? So fundamentally, one of them is trying to make substantial changes in tax policy as far as the percentage that corporations pay, at least, and the other is trying to make substantial increases in the amount that the wealthy pay. So it's a very different tax policy based on which candidate you're looking at. And so it might be interesting to understand that. And like I say, tonight's debate added some color or some detail on what they're trying to do. So we'll try to talk a little bit generally about tax policy. We're not going to dig in and make you all CPAs tonight, right? But the idea is just kind of an overview of what the purpose of tax is, tax policy in general, and some of the things that are important to know about tax. One of the things I always start with when we talk about tax is the fact that tax is one of these necessary evils of a modern economy, a modern government, I should say. So before you say to yourself, okay, let's just get rid of taxes. The government doesn't know how to spend our money anyway. We should just have lower taxes every time. That's how I'll always vote when it comes to elections. And you have a lot of people who say things like that. That's a rhetoric that a lot of people will use, is whoever tells me they're going to lower my taxes, that's who I vote for. Flip side is you've got folks who think it doesn't matter if you increase taxes because that'll just increase revenue and you'll be able to spend more as a government. Both parties and both viewpoints have disadvantages to them. In a perfect world, right, we wouldn't have to have very much tax. In fact, when the government was first formed here in the United States, if you look back in the history books, it'll talk about the fact that there was no federal tax initially. There's no federal income tax. Federal income tax is something that's come into formation, in more modern history, and then it's really gone up significantly in modern history as far as the dollars that we pay out of our income. So just a little history lesson there, but something that I think is an interesting exercise to go back and see the history of tax. But the bottom line is when you have a shared responsibility or shared economy, and for example, security of the country is a shared responsibility, right? That no one individually would be willing to pay for themselves, then it becomes important for government to be able to tax and have the ability to tax in order to support something that everybody wants. Everybody wants security, but nobody is willing individually to pay for unless they're forced to. Okay, so there's reason for tax. It's the same thing that you could say with a community that in a road, right? Think of you and all your neighbors, Frida. You and all your neighbors might want a nicer road, right, down your street, but it's unlikely that any of you are willing to go and foot the bill for that new road. Okay, because you'll want it to be perfectly fair among neighbors, and you'll want to not pay for it when there are other people on your street that are going to be using it. All those kinds of things come into play, and so tax is the easy answer. Tax from the community, and then go in and fix roads and build roads and schools and things like that, and provide services that everybody wants and needs potentially. At different levels. That's where we disagree, but everybody needs these services at some level. And the only way we're going to have them is if government has a role, right? Because if they don't have a role, then people's greed will take over and those services won't be provided. Okay? All right. So one of the things I wanted to do tonight before we get started with a little bit more about tax is just to review the assignment for this week. The assignment is question 9 on this page. It might be too small for you to be able to see, Frida. I don't know if it shows up. Actually looks like my screenshot cut off the right side a little bit, so it's not really, you're not able to read it all, but I wanted to show it to you just so you feel comfortable when you get to it this week. It's just question 9. We do need parts A, B, and C, right? And it's material right out of chapter 4. Okay, so if you review chapter 4 briefly and then get to the scenario or the problem on on number 9, you'll be in great shape. I've also updated the assignment so that it actually has a page number associated with it. I find that that helps, and so you can just stick that into the ebook, right, and get right to this question. Because how I like to do these chapter end questions is I like to go in, read through the question, try to understand it the best I can, and then read the chapter instead of the other way around. Because sometimes these chapters that are 40 or 50 pages long, you might just miss a few things. But if you know what topic you need to know for the assignment, then you'll read it extra carefully, in those parts that you need. Just like how we, format the tests each week, where we'll spend a few minutes at the end of class tonight again going over the topics that you need to know for the test. The point of that is when you read, you'll read with purpose, right? You'll read to try to find the information that you need to know to get to the test, or to get, in this case, to the assignment. Okay? So any questions on the assignment this week, Frida? I know that's just a really brief introduction, but it's a small case study problem. It's not going to be difficult, but it'll help to have reviewed chapter 4 in light of reading the question, so that you understand the question before you get to it. All right, so let's talk about federal income tax for just a little bit. Like I say, this is just going to be kind of an overview about taxes in general, and then we'll go over a few different things like that, and then we'll go over some savings issues in chapter 4. But this is chapter 3. Just moving my laptop here real quick. Okay. So Internal Revenue Service, of the IRS, is the administration and the enforcement of federal tax laws. So when it comes to tax policy, there's the generally accepted accounting principles, which I think we'll talk about here in a second. But the IRS, in the end, is who enforces and creates, administers the law. Congress creates the law. The IRS administers and enforces the law. So when we say a typical family pays more than a third of their gross income in various taxes, it's not all federal income tax. In fact, a lot of Americans, the middle class to the below middle class, whatever you want to call that category, most of that category, the lower middle class to lower class, doesn't pay anything in income tax. In fact, if they do pay anything out of their payroll, they end up getting most of it back. That's the tax returns that a lot of folks are getting in the spring. So statistically speaking, a lot of people don't pay very much federal income tax, but almost everybody pays, sales tax. Almost everybody pays, of course, corporations have to pay payroll and income taxes. You've got Social Security taxes, Medicare taxes. You've got estate taxes. You've got corporate, like we mentioned, corporate taxes. You've got sales taxes, property taxes. You've got what we call sin taxes, so extra taxes over and above regular sales tax on things like alcohol and tobacco, things like gas. There's a gas tax. There's a tax if you go and stay in a hotel, an extra surcharge or tax associated with that. There's an extra tax when you have a cell phone, right? That cell phone bill that's supposed to be $120 but ends up being $150, right? Because of all the extra charges and taxes associated with your bill. So there's all kinds of extra taxes, even beyond the federal income tax or state income taxes. There's all kinds of different things on top of the federal taxes that are due. And the bottom line with taxes is there's basic categories of tax. So one of the categories of tax, Frida, is a progressive tax structure. So this format of taxation says the higher, the more the amount, the more the rate, okay? So think about this for a little bit. Don't let it trip you up. When we talk about progressive taxes, it's not just that you pay more. It's that you pay a higher percentage, right? Because as opposed to a flat tax, right? So if there's a flat tax of 10%, and it doesn't matter how much money you make, you're always going to pay 10%, that's different. A progressive tax says that the person who makes $30,000 a year might pay a 10% rate, and the person who makes $250,000 a year is going to pay a 35% rate. So when it comes to our federal income tax policy here in the United States, it's a progressive tax. Okay, the more you make, the more you're going to pay as a percentage, not even just as an amount, but also a percentage. So when it comes to a flat tax, you will pay more the more you make, right? Because it's a flat percentage, but your percentage doesn't go up. Okay, that's a key difference between progressive and flat taxes. Another type of tax, and this is an example of the progressive tax and how it looks on a 2010 return. This is, of course, all gone up. Now the top bracket is 39% instead of 35, just as a heads up. And that's just federal income tax. That's, you have to tack on top of that your state income taxes as well. So the top bracket of taxpayers can pay anywhere from 40 to 45% of their income. Almost half their income goes to just individual income taxes. That's not to mention, you know, property taxes, sales taxes, estate taxes, gifting taxes, and other taxes that we've talked about, like specialty taxes on gas. Okay. So it talks about different filing statuses. One of the things that I want to mention just real quick, we talked about how progressive taxes work. We talked a little bit about flat taxes. When you talk about sales taxes, okay, let's think real quick about sales taxes. Let's say in the state of Utah, sales taxes are about 6-7%, somewhere in that range. And on food is usually taxed at a lower rate, might be like 3.5%, but regular sales tax is up closer to 6. So we would refer to the sales tax as what's referred to as a regressive tax. Okay, a regressive tax. And what does that mean? Regressive tax policy hurts the poor on a relative basis more than it hurts the rich. And why does that make sense when it comes to sales tax? Well, as a percentage of their income, the poor are buying a lot more food and things that have sales tax associated with them than the rich are. Now, the rich are buying more, right? So if I make $30,000 a year, I might have a $200 a month budget for food, right? And the next guy, my next door neighbor who makes $500,000 a year because he's a specialist, an orthopedic surgeon, and makes $500,000 a year, he might spend $5,000 a month on food, okay? But still, on a relative basis, that's a smaller percentage of his income than I'm spending because I make so much less, right? And because of that, on a relative basis, as a percentage of what I make, I am going to be paying more sales tax than my rich neighbor. And once again, on a relative basis, he's going to be paying more, right, in sales tax, but on a relative basis, it's going to hurt me more because that tax hurts me more because I make less, right, on those things that I purchase. So regressive tax policy basically hurts the poor more than it hurts the rich, just on a relative basis. It doesn't mean that it takes more money away from them or that the tax is higher. It just means that on a relative basis, the poor will take more of the brunt of that tax. That's exactly why states like Utah and others have lowered or even eliminated the food tax. Okay, that's why when you go to Walmart, you might have two different tax rates. You might have a grocery tax rate, and then you might have a non-grocery tax rate, right? Your non-groceries might, in the state of Utah, they're taxed at almost 7%, but your groceries are taxed at like 3.5%. So it's a whole different tax rate for groceries. And that's government, that's local government trying to, in this case, the state of Utah, trying to equalize the fact that sales taxes are regressive and hurt the poor more than they hurt the rich. Okay? So you've got progressive taxes, flat taxes, and then regressive taxes. Those are the basic categories or structures of tax. So we know we have different filing statuses on taxes. I'm not going to go through those. Taxes, as a general rule, and this is kind of a misnomer that people don't understand about tax policy for federal income tax, it's a pay-as-you-go format. So if you run a business, you might say, well, this is great because I don't have to pay taxes like I used to when I was working for somebody. When I was working for somebody, they forced me to pay taxes out of my payroll, right? And now that I've got my own business, I don't have to worry about taxes until tax time. Okay, well, if you make money and you have a small business, that works for 1 year. And then, according to federal law, you have to pay estimated taxes going forward based on your previous earning. Okay, estimated meaning, we don't know exactly how much we're going to make this next year, but we can estimate based on last year and pay as we go on a quarterly basis. So it might sound good that you'll be self-employed and you won't have to pay taxes until the end of the year, but that goes away very quickly. According to federal law, according to IRS policy, you are to pay taxes as you go. And potentially, and I haven't seen the IRS do this very often, I tell my clients they don't spend a lot of their time doing this, but as a part of policy, they could actually come back and charge you fines if they found that you weren't at least estimating the tax due at the time that you receive, the income or benefit of whatever kind it is. Okay. So if you get a big windfall, for example, they might even withhold the tax at the time that you get it so that you actually fulfill the law, which is to pay as you go. And that's exactly why employers, with every single paycheck, withhold for taxes. So taxable income matters most. This is just a quick slide to let you know that basically everybody has deductions, and it's really only the taxable income that you make that matters when it comes to federal income tax. You have either a standard deduction, which is pretty significant, or you have itemized deductions, which can be very significant as well, that take away income that's going to be taxable, and then you're left with the taxable income, okay? And that amount is subject to income taxes. So if I have a lot of deductions, I lower my taxable income and in turn lower my tax. And that's why deductions are so important, to make sure and file those correctly when we file our taxes. So we've got three basic categories of income. We've got active income, like a W-2 that we get from our job. We've got portfolio income, like interest and dividends. And we've got passive income that comes from real estate, limited partnerships, and other things. Tonight, when Donald Trump and Secretary Clinton, Hillary Clinton were battling back and forth, one of the things that Hillary Clinton accused Donald of is of not paying any federal income tax, and that's the reason she's purporting that that's the reason that he's not releasing his tax returns. And he's saying, that just makes me smart. Okay, well, that speaks to this chart here. Not that he's right or wrong, but it speaks to this chart. If you have very little active income, this wages, salaries, bonuses, pensions, and alimony, it's a lot easier to manipulate your tax returns to not pay very much. So some years back, 8 years ago, 4 years ago, when Romney's running against Obama, one of the critiques of Romney is that he paid very little in tax. And basically his response is, I don't have a lot of active income that's taxable. I have a lot of portfolio income, but a lot of that portfolio income is in places that I don't have to pay taxes on it. And then I have some passive income that I basically can write off because of different deductions that I have. So he was legally within the law to do what he was doing. He just didn't pay a lot of tax. The flip side is, if you look at President Obama or Hillary Clinton's tax returns, they pay a lot of tax, in part because a lot of what they make is earned income, what we call earned or active income. It's income that they were getting from speeches, right, that year. And when you get speech income, you pay tax as you get it. There's no way around that. So that's one of the reasons that tax rates or effective tax rates can be very different, because you have different types of taxes based on where your money's coming from. Okay, so all income is basically subject to federal taxes. It doesn't matter what kind of income it is, it's subject. And some people have the misnomer that they think that things like alimony or things like lottery or gambling winnings aren't subject to federal taxes, and they're absolutely wrong. All those are subject to federal taxes. In fact, there's actually an excess tax or an extra tax on lottery and gambling winnings if it's a significant size. There's called a windfall tax that's even in addition to the regular income taxes. So, and you might say, well, I just wouldn't pay. I wouldn't document that I receive. Well, all the folks who give windfall winnings. So let's say you're playing the Monopoly game at McDonald's and you think, oh, nobody will ever find out that I got this $100,000, from getting, Boardwalk and Park Place, right? But actually, McDonald's is sending documentation to the IRS that year that you got that prize, right? So it's going to be taxable. Or if you see the prices right on TV, somebody wins $35,000 worth of vacations, cars, and other things, they have to pay tax on that entire amount. There's no way around it. What ends up happening a lot of times is people end up selling off half the stuff they win in order just to pay the tax, which is kind of a buzzkill, right? But that's just how it works. Okay, any questions on things that are taxed or any kind of income that's taxed? Okay, let's keep going. Talks about how to calculate taxes, talks about capital gains. Capital gains are on investments or on any property that you sell later for either a loss or a gain. So if I have a piece of real estate and 10 years later I sell it, if it goes up, I have a capital gain. If it goes down, I have a capital loss. Either way, it's taxable, but it's taxed differently than income. Okay, capital gains are usually lower tax rate than income. Just as an example, the average American will pay 15% capital gains rates. Okay, that's the bracket for most Americans with capital gains. Some people pay 0, some people pay 20, but most people pay 15% on capital gains. The average income tax rate is closer to 20 to 25. So average tax rates are much higher for income than they are for capital gains. Okay. Here's your capital gains rates that I just mentioned. 15%. This bracket's actually changed. If you were to look it up online in 2016, you would find that it goes 0, 15, and now 20. Okay, are the gains on capital, are the rates on capital gains. The less than 12-month capital gains, so if you hold something for less than 12 months, it's just taxed as your regular ordinary income. And we're talking about 2016 brackets again instead of 2010. This is outdated. Got adjustments and deductions to gross income. Lots of different deductions that are possible. Got a standard deduction, and then you've got itemized deductions. Some people don't have very many itemized deductions. They don't have a lot of mortgage interest or charitable contributions, and if that's the case, then they take the standard deduction. But whichever one is higher, that's the one you take. You don't take both. Okay. Got tax credits. There's some different things that give you tax credits. Some different returns. I'm not going to go through all these in detail. Forms. Basically, a 1040 easy is usually the form that most people are using. Pretty straightforward. At least the point is for it to be straightforward. And in fact, usually is very straightforward. That's why your Liberty Tax Services, H&R Blocks, all these different corner tax preparers, can have very, they get pretty good training, but it's pretty limited training because most of what they're dealing with is automated forms, that are electronic that they're filling out for a client basically to submit their 1040 from a W-2 and not really any other details. That's why they can process so many returns is they're fairly simple, fairly straightforward. Where, an average CPA doesn't do as many returns as your corner office services, and it's because their average return is a little more sophisticated, has a little more complexity to it. It's not just as straightforward. Okay. All right. Let's probably skip to chapter 4. Let me just see if there's anything else. So we know April 15th is the filing deadline. You have to pay quarterly taxes, as I mentioned before, if you've got a small business or income that comes regularly. You can file extensions, although you pay penalties and interest potentially. You can do it yourself, or you can go to a tax preparer. You can go to CPAs or just folks who do tax services like H&R Block, what we talked about. And then, of course, there's a lot of new technology to help you do it on yourself, like Tax Act, TaxSlayer, TurboTax. Those are all, TurboTax is probably the most common, but Tax Act is pretty common as well. But there's a bunch of different programs and software online to be able to do it. Yeah, Frida, good point. An accountant can do some calculations for you as far as deductions are concerned that if you were to do yourself, either you might think are a little too complicated to do and may not do it, which would be a big loss to you, right? I mean, it's much better to have somebody do it for you than if you weren't going to do it. And paying a couple $100s to an accountant a lot of times saves you quite a bit, time and energy and money. So you've got rental properties, you're trying to depreciate them. That's a good way to go, Frida. A lot of people don't have any rental properties. They don't have any extra investments or anything like that. All they've got is a W-2. And if all you've got is a W-2 paying, like a TurboTax or Tax Act, $30 or $50 to file for you and having the software just walk you through what you need to do, that's a viable option. If you've got a little more complicated situation because you have a small business or some rental properties on the side, I like your approach, Frida, where you might as well pay somebody so that you pay less to the IRS, just like you said. All right, so as far as terminology is concerned, just remember Avoidance is legal, evasion is not. So when it comes to avoidance, that's what you're doing there is perfectly legal. It's within the law to try to avoid paying more taxes than you should. And nobody faults anybody for that until you run for president. And then if you're legally avoiding taxes, people get upset at you. But in the normal situation for you and I, Frida, and everybody in this class who are not currently running for president that I know of, we're not in a situation where we need to worry about that. We should avoid paying more tax than we have to, right, within the law. But we should not evade taxes. That's where you get in trouble with the IRS, and that's where you go to jail, right? So make sure to try to avoid, but don't try to evade, of course. You can reduce taxes, shift taxes, defer taxes. Okay, let's go to chapter 4. About managing cash and savings. All right, so Frida, can you see role of cash management and personal financial planning on the top of the page? I just want to make sure that the program, okay, good. So a couple things we want to talk about here, and then we'll get to reviewing the test for a few minutes. The material that's going to be on there shouldn't take us very long at all, though. Like I say, there's just 10 questions, 5 points each, and they're not hard questions, so they're pretty straightforward. Should be a good week for most of you on the test. But when we talk about cash management, we're talking about, if we were talking about corporate finance, okay, if we were talking about corporate finance, we would call this working capital, okay, managing our working capital. But since we're individuals, we don't need to use fluffy corporate finance language. We'll just call it cash management, right? It's the day-to-day use of liquid assets, or for most of it, it's the day-to-day use of the cash, the resources that we have. So for some people, it's a checking account. For some people, it's a cash in the bank, or I say bank, but maybe even a cash at home, right? You're getting paid cash. Maybe you're a cash-only type person, or maybe you use an account. What I've found that's fairly typical in classes that I teach online is that a lot more people than I would have assumed are cash only, right? They don't even have a checking account. They don't even have a bank account. They use cash, and that's all they use for their transactions. For me, my mom helped me get a checking account when I was like, I don't know, 14, 15 years old. And ever since then, I've had bank accounts, right? But a lot of people, use alternative banking, what we call alternative banking. They use cashier's checks, they use money orders, they use cash, they use payday loans, they use all kinds of, pawn shops, they use all kinds of methods, title loans, those kinds of things. They use all kinds of methods outside of traditional banking, but they don't really use traditional banking. And for some people, it's because the banks won't take them. Maybe they opened an account at some point, had some problems with it, overdrafted it, and then it closed out at a loss. Well, all the banks then find out that happened, and if you go into another bank, then they won't let you have an account for a while. Or they might, let you have a restricted account, and maybe it has really high fees on it. So there are some reasons why people don't have accounts, but some people just don't, they just have never had an account. They don't even know, how to use them, and they're a little bit intimidated about going and using a banking account. Frida, I agree with you. I work at a bank, though, so I realize some people are going to say, of course you would say that. Of course people should have a bank account. But my experience is banking makes my life much easier from a financial standpoint. I'm able to pay bills very easily. I'm able to transfer money very easily between different places. I'm able to pay off debts and pay other people even very, very easily. So it just makes my financial life a lot easier, and I don't pay any fees. I have an account where, I know I can manage it and not have any expenses associated with that account. Yeah, so Frida, you may be in a situation where you work for an employer, and a lot of employers are like this now that only do direct deposit. However, a lot of government entities, a lot of non-government entities, I should say, a lot of businesses will do a direct payment onto a cash card. And so people who don't have accounts can use cash cards that get direct deposited onto. This is how unemployment worked in the state of Utah, at least for a while, where they would deposit money every 2 weeks for unemployment, or every week, excuse me, onto a cash card. Basically, it was like having a debit card where the card would be money would be uploaded onto the card, and then they could spend off that card like using a debit card until their money was gone, and they had no overdraft or ability to spend more than what was on there, and they needed to keep track, obviously, of how much was on the card. But that's how they kind of get around having traditional bank accounts. They would have these cards that got money uploaded onto them by their employer. Okay? Or in the case of unemployment, it could be government again doing that. So cash and other assets, any assets that can be easily and quickly converted to cash with little or no value are considered liquid assets. Okay? And liquid assets, like I say, are really important because that's how we manage day-to-day operations. If we need a few bucks, that's where those few bucks come from. If a bill comes, that's how we pay that bill, is with our cash management. Some people are very good at cash management, other people struggle. Frida, I think based on things that you've said in the past, I think this is something that you're good at. But a lot of people don't have any experience budgeting before they get their first job. And when they get their first job, what happens is every 2 weeks when they get paid, they spend every dime they get, right? And they have a hard time making that money that they got last over 2 weeks. And then they get in a situation where managing it's very difficult, right? Because if you use every dime of it as soon as you get it, then it becomes a situation where you have to turn to maybe alternative financing and stuff like that to bridge you until your next paycheck. Well, that bridging usually costs a lot of money and gets you into some trouble sometimes financially. Okay. And a lot of people will say, well, that's it's easy for you to say because you make more money. If you don't make any money, make very little income, then it's a lot harder. But I guess my comment to that would be I've met people that live on very, very little, make very little income, but are still very, very disciplined about how they manage their money and spend their money so that they still have enough, to last them between paychecks. So it's not as much, I guarantee it's easier for people. It's not easy, but it's easier on a relative basis for people who make more money to manage it and to not have as many problems in between paychecks. However, I've met a lot of people who make a lot of money who still don't know how to manage their money and end up getting in trouble all the time because they can't figure it out. And then I've met people that make very little who do a very good job. Yeah, I completely agree with that, Frida. The less you make, the more vigilant you have to be about how you manage it, right, and how you spend it. And that's really cool that you had an opportunity to help other military members to figure out how to manage their money, because it's a skill that is really lacking. When I first came to Utah about 15 years ago, they were talking about making a personal finance class mandatory in the high schools here, in order to have high schoolers come out of school with at least some experience or at least some education regarding finance. What they were finding is most parents don't do a very good job talking to their children about this subject. So about, I want to say 6 or 7 years ago, I was delighted when the state of Utah made it mandatory. Now every single high school graduate in the state of Utah has to take a personal finance class before they graduate. And I think it's helping. It's kind of mixed reviews from the high schoolers that I talk to. Some of them say, it's a hard class because the people teaching it aren't very good at teaching it. Usually they take other subject experts, like they'll take the English teacher, they'll take the math teacher, they'll take, the history teacher, and they'll have them cycle through teaching these personal finance classes. And some of them, because it's not a passion, it's not what they studied, school to go teach, they just don't have a lot of enthusiasm about what they're doing, and it becomes kind of one of these boring, mandatory classes. And as soon as that happens, they kind of, students kind of check out. They don't get a lot from it. So years ago, I volunteered to go into schools and teach a course like this for free, just to do it, as a community service, and the schools wouldn't let me. I think in part the school districts wouldn't let me because, this was a way for their teachers to pick up another class. I can't prove this, but I think that's basically what was happening with the districts. when you tell somebody that's in the business that that could really add, I think, a lot of value and do it for free. They're just saying they want to do it as a community service, and you say no to that, I think there's something political going on, most likely. Okay, but it is positive that is mandatory now, at least in the state of Utah, and I think other states are looking at it. I don't know, Frida, if you know if where you live that's the case or not. Okay, we'll get back to you on that. So you've got financial products and then you've got financial services. You can look through these lists, pretty self-explanatory. You got things like insurance and mutual funds, of course, those are products. And then you've got things like planning, tax prep, real estate, trust work, like what attorneys do with estate planning and trust. Those are services. And usually professionals in these different industries, these financial service industries, are providing both, right? So in my world, I provide advisory services. I give people feedback on what they should do for retirement planning, what they should do for estate planning and insurances and investments. And then I also am able to offer products if people would like, to employ me for that and actually execute on the products that are available to them. So like I say, a lot of professionals will be in both places, right? They can do both products and services. You've got depository types of institutions like banks, and you've got non-depository institutions that are still financial, like a mutual fund company or life insurance company, right? We don't consider a life insurance company like New York Life or Northwestern Mutual a depository company. However, they are significant financial companies that end up being a vital part of how our economy works, because they throw a lot of money back at the economy. We pay premiums, they have to hold reserves. What they do is they take those reserves with the life insurance companies and go out and buy lots of real estate, they buy businesses, they buy different investments, and it really props up the economy to have these big insurers and other big non-depository institutions that are significant players in the economy. Got commercial banks, big commercial banks, of course, like Chase Bank, Wells Fargo, Zions Bank. You've got savings and loans. 1994 was the S&L crisis, what we call the savings and loan crisis. A lot of these traditional S&Ls are gone. They either went out of business in 1994 or post 1994. If they made it through that period of time, they ended up getting bought by other banks. Okay, so back in the day, Washington Mutual, the bank, I don't know if you're familiar with Washington Mutual, Frida, but that was started out as more of a traditional savings and loan, and then kind of morphed into a pretty big commercial bank before Chase Bank bought them and took them over in 2008 or 2009. Anyway, not as common to run into an S&L now, a savings and loan. Not as common to run into a savings bank. Most of these are commercial banks now. It is very common though, and like the state of Utah, for example, has a flourishing credit union culture. Why? Because people in Utah are just as a general rule, and I'm speaking for myself as well. I live here. I'm a citizen of Utah. Fairly cheap and fairly, we tend to be more cost sensitive, fee sensitive, and so credit unions, a lot of times will be a little more efficient when it comes to costs because you're a member, right? And they're a non-for-profit technically, institution, as opposed to the banks that usually have shareholders and have to make sure that they're highly profitable. Now, having said that, most credit unions are very profitable as well, right? That's just how it works. But if the perception is that credit unions are less, they gouge you less and they pay you higher deposit rates, then great. Yeah, it sounds like that's been your experience, Frida, that your credit unions have less costs. Now, for military personnel, right, you've got USAA, which you can get like life insurance, and they have depository, products that you can use, but it would be online, right? It wouldn't be through branches, but USAA is great. So technically you're dealing with a bank and a credit union, right? But as far as your traditional depository needs, it sounds like you use a credit union, which is great. They're a good option. You've got two different insurers. You've got FDIC and NCUA. FDIC is for banks, NCUA is for credit unions. Both of them protect people up to $250,000 in deposits. And it's amazing. A lot of people will say, hey, you know, I work at, I have some money at a credit union, I have some money at a bank, because who knows if the NCUA or, if the insurance that the credit unions have will be there. Well, it's the same government, is backing both NCUA and FDIC, and both of them have limits up to 250,000, which was changed back in 2010, by the way. Nice. I don't believe in Utah we have any USAA locations, even though we've got Hill Air Force Base, which is pretty significant up in Ogden. But I'm still pretty sure that USAA doesn't have physical branches in Utah. I just know some people who use them online, right? So do online banking and have insurance and stuff like that. Cool. Texas is a cool state. Just got cooler because it's got USAA. They're a great company. All right, when we talk about checking and savings accounts, we're talking about checking is a demand deposit, savings is a time deposit. Really, I mean, this is just fluffy language for basically saying, look, checking's your put and take money, savings is something that you're expecting to keep there for a while and try to get some interest. Now, nowadays, and you know this well probably, Frida, savings accounts, even though we call them time deposits and that's the place where you're supposed to get interest, there is not a lot of interest to be had, right? I mean, savings accounts right now, the national average for savings accounts is like 0.2%, which is horrible. You're getting 0.2% in annual interest by keeping your money in a savings account. But historically, you might get 2 or 3 or 4 or even 5% from a savings account, right? So it was a substantial value add to move money out of your checking account into a savings account to get the extra interest. Now, from a banker's standpoint and from a bank standpoint, and I work at a bank, and so I can say this, there's more liability from a fraud standpoint on a checking account than there is from a savings account. So we'll tell a lot of people, okay, separate your put and take money, your operational money, from your non-operational money, and take all your non-operational money and move it into a savings account. Yeah, you get a little bit of interest, but more importantly in today's situation, because it's not a lot of interest, but more importantly, you're more protected from fraud in a savings account than you are from your checking account. Yeah, 4 to 5%. That would have been nice. I still have a lot of people come into the bank and tell me that they remember the days of 12, 14, and 16 and 18% on CDs and savings accounts back in the 80s. And I tell them, that'd be nice. But we don't want the other side, which is that when savings rates are that high, that means that borrowing rates are super high as well. So you'd be paying 14, 15, 16% on a mortgage. And all of us really like our 3 and 4% mortgages right now. So as much as we like to complain about the savings rates, right, we also, the flip side of that is the borrowing rates are very, very low. The problem is for my older clients who have saved their whole lives and paid down all their debt, they don't have any debt, but, they have all this savings, but they're not getting paid anything on it. So they're not benefiting from low interest rates on the loan side because they don't borrow any money. But yet they're really getting killed on the savings side. It's just the younger people that when they complain about rates, I'm like, yeah, but remember, you're getting a great rate on your house and a great rate on any car that you might finance. You got a great rate on your credit card potentially. All these things are because rates are low. Different kinds of checking accounts. This is kind of a non-issue. You've got interest-bearing accounts, you've got non-interest-bearing accounts. And really anymore, the difference between these two is non-existent because the interest-bearing accounts pay so little it doesn't really matter. Got money market accounts, which are kind of a variation. I mean, they're more close to a checking account than they are a savings account, but they pay interest more like a savings account, which right now, once again, very low. So that last slide says that money market mutual funds pay interest 1 to 3% above regular savings. If this slide were to be updated for today, you'd be getting like 0.1 to 0.2% above regular savings. So you'd get like 0.3. I mean, it's horrible. Yeah. No, Frida, I mean, the only thing I can do is kind of joke about it because it's that bad. If I try to be serious with my clients about what they're going to get on their savings accounts, CDs, money markets, they get angry because it's that bad. I mean, they're not getting hardly anything. All right, not interested in that. Basically, this talks about, should I open a checking account? What are the advantages? Their checking accounts sometimes do have costs, obviously. Sometimes they have minimum balance requirements. Sometimes they have different service fees associated with them. So you just want to make sure you understand all the pros and cons of a checking account from one bank to a next before you get into it. And don't underestimate the fact that there are online banks now that provide all very similar services as your brick and mortar banks, your traditional banks that you walk into, and you might not need a brick and mortar bank. Some of these online banks have much lower fees, have higher deposit rates, and you can do everything that you need to do. You direct deposit your money in, and you pay all your bills electronically, and it really doesn't. You don't need, a physical location like we used to. Now, if you really value sitting down with somebody at your bank and talking through different things, then you probably should do a traditional bank. But I just don't want people to think that that's the only option. There are definitely some online opportunities that I think are very, very good. Yeah, yeah. I mean, that's a great example, Frida. I'm glad you shared that. You live in Florida, your bank's in Maryland, and you're probably doing just fine, as far as being able to get the services that you need. And if you're not, at some point, you can walk into a bank in Florida if you had to, and pick up, a certain product or whatever. But most of the services that we use anymore, as far as getting a check from our employer, that goes right into our account automatically. And then as far as paying bills, a lot of people think of, well, I got to write out checks to the different people I pay bills to. Not necessarily. You can do bill pay, which is a service through a bank where they write a check basically for you and mail it for you, and it doesn't cost anything. And you could also, do automatic bill pay, where they just ACH the money each month with your permission. Yeah, good call. A lot of banks, kind of like the airlines, how the airlines will have strategic partners, to get you from one place to another, even though you booked your flight with one, you know, maybe I booked with Delta, but maybe I fly somewhere on SkyWest, and it's Delta that arranged that, but SkyWest is kind of partnering with on it. Same is true for banks. A lot of banks will have, you know, partners, basically associate banks around the country, so that if somebody does move, they've got access to their money if they needed it, or access to services through that other member bank. Well, when it comes to savings program, there's only one way to be successful, and that is to be disciplined about paying yourself first and make it a consistent automatic program. Okay, consistent automatic program of paying yourself first. So there's an author, David Bach, who wrote many books, but one of them is just Automatic Millionaire. And it's kind of a hokey title, kind of one of these books that you probably see at Barnes and Noble and think, oh, great, it's probably a stupid book. But it's such an easy read. It's a very, you sit down for a couple hours and knock this book out. But the point David Bach makes in this book is that he's a financial advisor, and after years and years of meeting with different people, it comes down to just a couple quick things, when it comes to accumulating wealth over time and saving. And one is that people have done it automatically. That's why it's called Automatic Millionaire. They've made it automatic where they don't have to think about it each month. It just automatically goes in. That's one of the reasons that a lot of people end up with just their 401k when they retire and no other savings, because the only thing that they automated about retirement was their 401k. Everything else wasn't automatic. They always intended to save in an IRA, or they always intended to invest, or they always intended to do something else. But we get busy with life, and financially it's very difficult to do things that aren't automated with your finances. So you want to automate your savings. You want to be consistent about what you're doing. And it's not as nearly as much about the product that you use as it is about the process, right? Of being systematic, automatic, and consistent. So we want to make sure that we get some interest. Obviously, compounding interest is much better than simple interest. Difference is compounding interest pays you interest, on your growth, where simple interest doesn't pay you anything on your current interest that you've received. So simple interest and compound interest don't make a big difference in the first couple years, but you get a few years down the road and compounding interest starts to just be significantly different, significantly better than a simple interest. You've got nominal rates and effective rates. Effective rates are really what you're getting. Nominal rates are just the published percentage, but an effective rate is based on the period that you're getting it, and then is also updated for whether or not it's compounding or not. So for example, a nominal rate of 5% per year, if it compounds only once a year as far as interest is concerned, would still be 5%. Effective rate would be 5, and the nominal rate would be 5 because its annual percentage rate is 5% and it only compounds once a year annually. But if you have a 5% nominal rate and you compound every month or every day or every minute or every 6 months or every 3 months, if you have more often compounding than just once a year as far as the interest associated with your rate, then your effective rate will be higher. Okay, your effective rate will be higher because you're compounding more often. And the more often you compound, the higher the effective rate will be. Okay, here's the nominal rate versus compounding rates based on how often you're compounding, like I just described. But graphically, sometimes that helps us to internalize what we're talking about here. Okay, I think that's all I want to cover from chapter 4. So now let's cover the topics that you'll need to know for the test. Okay, unless you have any questions, Frida, before we get to that. So Frida, we were competing tonight with the debate between Clinton and Trump. It's the first one. We were also competing with Monday Night Football. I mean, there's all kinds of problems with tonight as far as the session is concerned, and I really appreciate you being here. Again, and you always offer such great comments. It really does help, I think, for folks who aren't on, aren't able to make the live session, but still really benefit from, kind of this dialogue that you put in. I think it really helps. So I just appreciate you. Appreciate anybody that can show up to the live sessions. Although I understand that for many people it's not something you can do. It's especially late where you're at too, Frida. So I've probably put you to sleep a couple times. You probably need some serious caffeine to get through the class. Anyway, okay, so let's talk about topics for the test. The first topic that you need to know for the test is, we talked about general categories of taxation. We talked about regressive tax, progressive tax, and flat rate tax. And we also told you what type of tax the federal income tax is. Okay, which one of those categories the federal income tax is. So that's what you'll need to know for number 1 on the test, and you'll get that one right. Number 2 on the test. Number 2 on the test asks you where most of the revenues into the IRS come from. Okay, so the chapter 3 will talk about where revenues come from, right? They've got property taxes, corporate income taxes, federal income taxes, capital gains taxes, passive tax. Anyway, there's lots of different types of taxes like we talked about. You'll need to know for number 2 on the test which one of those taxes is the bulk of the federal revenue, right? Of the revenue that comes into the IRS. Okay, which one of those types of taxes is the bulk, is the largest component, the largest part of the money that the IRS brings in each year. Number 3 on the test, once again, kind of a repeat of number 1, just knowing what the federal income tax is, whether or not it's progressive, regressive, or flat. Number 4 on the test, you'll want to understand the Social Security tax, where it comes out, whether or not it comes out from the employer, the employee, or both. Okay, you might already know that offhand. But where does the Social Security tax come in? Does it come out from the employee, the employer, or both? Number 5 on the test is about mutual funds. And basically, it's just one of these questions that asks you what are one of the advantages of mutual funds, which is kind of a repeat from last week, right? We talked about why people, pros of mutual funds and ETFs, how they're diversified, professionally managed, have economies of scale, all those things. But this week, there is a question on mutual funds. You know what? I misspoke. I told you that this isn't a comprehensive test. And actually, as I look at number 5, it's obvious that that's a repeat from, or not a repeat, but a topic that we covered last week. So you are going to have some questions from previous weeks on this, but you'll know what they are before you get to it. So don't get stressed out. I just had looked at the first 4 or 5 questions. They were all about chapter 3, and I thought that it was just from tax and savings tonight. Number 6 on the test, you'll want to know the relationship between the yield and the value of an investment. This is something that's a repeat, I think, from last week's test, which is as the price of an investment goes up, the yield, the effective yield of that investment, or the dividend percentage that you're getting, actually has to go down. Okay, because the dividend percentage isn't gonna keep up with, they're not going to change the dividend every single time the price of the investment goes up, right? Price of the investment can go up or down every single day, and depending on which way it moves, the effective yield of that investment from the dividends will either go up or down, but it'll be inverse to the value. So if the value goes up, dividend goes down. If the value goes down, dividend goes up, right? It's an inverse relationship. Okay, that's what you'll need to know for number 6. Number 7 on the test, you'll want to know how we measure the risk-free rate of return. That's definitely a concept from last week. How do we measure the risk-free rate of return when we're doing a problem about returns, right? If we're trying to calculate what the risk-free rate of return is, what do we use as our number for the risk-free rate of return? How do we find that? What do we use? What instrument do we use to find the risk-free rate of return? Number 8 on the test is a question about checking accounts versus, interest now accounts. We saw some slides about that. We didn't go into it very much detail, but you'll need to know the basic difference between interest-bearing checking and regular non-interest-bearing checking. And that's questions 8 and 9 on the test. They're both checking questions. Number 10 on the test goes to what we talked about here at the end of class today, where you pay yourself first, right? You make it automatic, you make it systematic, you make it consistent. Okay? And if you understand what the book has to say about how you should save for yourself, and creating a savings plan for yourself to invest for the future, you'll be in great shape on that one. Okay, that's number 10. Those are your 10 questions on the test. Shouldn't be too hard at all. Pretty straightforward, Frida. You probably, as I was going through those topics, are thinking, yep, know that. Yep, I know that. You should be in great shape. Just do a quick review before you get to it. It'll make the test very easy for you. Don't get tripped up by how the questions are asked. Read through all the answers. Do the normal things. Even though I've told you the test is pretty simple and straightforward, I don't want you to rush through it and then miss a few things just because we didn't really carefully read the questions. Always do that. Always read through the answers a couple times. Make sure you understand them. And then you should be in great shape, though, this week. All right, that's all I have for tonight. Any questions on the topics for the test, Frida, before we wrap up? All right, hey, thanks so much, and have a great week this week. Let me know via email if you've got any questions or concerns as you get started on the coursework, and have a great week. Thanks, you too, Frida. Have a good night.